slew of banking results that came through, but you're interested more in First Bank that reported an increase of pre-tax profits of 637%. That's a very impressive performance. What do they attribute it to?
Well, yes, First Bank saw quite a leap in its bottom line, with its PBT rising 637% to 32 billion. Its top line, on the other hand, that's its gross earnings, were down 6.7% to 122 billion. Key points to take out of the results. I mean, the top line, of course, recording sort of a tempered performance. Simply because, the banks are much more cautious now in building their loan books. But as regards the bottom line, of course, we've seen interest margins improve, especially on the back of the significant decline in term deposit rates. We've also seen write-backs. When you take that in the context of the amount of write-offs that the banks had to take in the last 2 years, there's significant potential for write-backs going forward. Also, the bank's focus on diversifying its income. We've seen its investment banking and asset management businesses flourish, reporting pretty strong performances, which have added to the results. We have to recognize the low base effect as well, because the results for the same period last year had significant provisions. Its asset management business, for instance, over that period reported a loss of 25 billion naira. So, of course, that's enabled the sort of growth in earnings we've seen in these results.
All right, Deji, let's talk about the provisioning of about 60 billion naira in the last year. We know that First Bank is one of the better performing Nigerian banks. It's a tier 1 bank. It's a major banking lender in the economy. But how have they been affected by the reforms that were instituted last year and the introduction of very stringent rules for capital adequacy, liquidity ratios and the like?
Well, I mean, the reforms have really been a double-edged sword. On the one part, they've been forced to, take significant assets impairment charges on the back of the CBN reforms. But on the other hand, we saw during the period, for instance, a flight to safety, to which, they were a net beneficiary. We've also seen, in line with the dip in deposit rates recently, that the cost of funds has diminished. Nevertheless, banks have struggled. Banks like First Bank and other tier 1 banks, and the industry as a whole, have struggled to build their asset books. It's been really difficult building their loan books, simply because of the renewed focus on risk management. So it's really double-edged to that extent. But it holds long-term benefits for the industry, because the spate of impairments going forward really should diminish. Also, with the AMC bill being signed by the president yesterday, it offers them another avenue to replace toxic assets with liquidity, although, I mean, First Bank hasn't specifically stated that it intends to access it.
All right. Now, how have the results impacted on the First Bank stock, and what's the upside for the stock, or the ratings of the stock?
Well, First Bank's performance today, it's reported a decline in its share price, but just looking forward for the current operational year, we maintain a neutral position on First Bank. We estimate that its earnings will come in slightly over 50 billion naira. That's its profit after tax for the current financial year, which will put it on about 1.6 times book value, and just about close to 10 times earnings. We believe that given its size, its retail network, the number of customers that it deals with, that it has a lot of growth potential. We also highlight the fact that that growth might be tempered by its capital adequacy ratio, which is slightly below 20%. But we think it's in a good position, and given the caution with which the bank is building its loan book, this should portend pretty good results for it in the medium to long term.
All right, now you've spoken us through the various divisions, the asset management division, the retail banking division, the investment bank, and how they've performed. But let's focus on the relatively poor performance of the mortgage banking division of First Bank. Profits before tax of 2 million naira, down 99%. To what extent has this division been affected by the interest rate cycle, the lower lending rate, and just general challenges within the property sector? Because most property analysts in Nigeria have argued for some kind of action by the CBN just to boost the sector.
Well, that side of its business, its mortgage business, has been affected by two main things. Of course, the value of real estate assets have declined, at least over the last 18 to 24 months. Also huge operating expenses, although we note that the bank has downsized, and a lot of the charges, the related charges, were one-offs because of the downsizing that went on in that area. But the real estate sector as a whole has huge challenges. A bubble built up there which later burst. There are fundamental issues, especially at the high end of the market. I think one key thing one may highlight is the huge differential or disparity between rental yields, for instance, and the cost of mortgages. Rental yields are probably about 5% at this point in time. And your typical mortgage is anything north of about 14–15%. So, fundamentally, there are huge questions being asked in that sector, and something has to give. Either those yields go up or the cost of of real estate, the real estate values come down. So there might be, even more depletion of value within that area, and it's a real cause for concern for a lot of participants there, especially at the high end. The middle segments might hold more opportunity.